This week, we saw the relationship between the 10-year US Treasury Bond and the 2-year US Treasury Bond invert. Now, this is putting a lot of caution to investors about what the future economy looks like. So in this video, we'll be discussing what a traditional normal curve should look like and what it means when it is inverted, especially for the future of the economy. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you get some value or you learn something new, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting that subscribe button and turning that notification bell on for similar content just like this. And it seems like the world is coming to an end. All of a sudden, investors all over Twitter, all over the news are saying a recession is imminent because of the fact that this bond yield relationship between the 10-year and the 2-year has inverted. So let's start off and talk about what you would want if you're a normal investor. So as somebody who wants to put money in for a long period of time into something like a 10-year bond, you're going to want a higher percentage yield. This is because you have to battle things like inflation. You don't know what's going on if you need that money relatively quickly. So you want to be able to know that the yield that that bond will generate will be higher. And then on the flip side, we know that in the short run, you won't get as much yield for your shorter term bonds. So what the traditional relationship or what a normal curve should look like is a chart that we'll pull up here. So from the left, heading all the way up, steepening to the right, this is traditionally what the bond curve should look like. You want to know that in the future, you're going to be generating more yield, especially if you lock up your money for a longer period of time. Now, what does it mean when it's inverted? Well, we can look at the chart here and we can see that it is coming downwards. You would actually make less money today for keeping your money locked up for longer. We've touched on this multiple times, whether it's the 60-40 portfolio, that being dead, or bonds being dead for younger investors, just because the fact that the yield that they're producing today isn't keeping up with inflation. So it's almost a bad bet right from the get-go. So we take a look here and we see this inverted yield curve. Moving along, we're going to take a look at what it means. What is going on right now in the economy that is kind of causing this to affect? Now, there's a couple things that are going on. The first part is shorter term bonds. The shorter term bonds are saying that the US Fed is going to raise the interest rates. That means that everything becomes higher, whether it's loans or mortgages. So these shorter term bonds are actually getting a higher percentage yield. Now, what's happening on the back end? On the back end, we're seeing a risk that the US Federal Reserve is making a mistake. They're raising the rates too fast to obviously curb inflation, but the risk that they're taking to kind of raise these rates really fast is dampening the economic outlook in the long run. So we're seeing shorter term bonds kind of increase in interest rates due to the fact that the Fed is increasing that overnight rate. And then on the back end, we're seeing, oh no, they could be potentially making a mistake and this could hurt our economy in the long run. So the yields are dropping. Now, where does this become important? We're going to take a look at some statistics. And this has been measured, this relationship between the 10-year and the 2-year since 1900. And the curve has inverted 28 times. Now, out of that 28 times, it has led to a recession 22 times. So it is a very good indicator to say that there is potential economic damage coming in the interim. And that's been reported as to 6 to 36 months after it's inverted. So we'll take a look at the chart here just to give you an indication. And we're on the Fred website here, and we can see that the relationship at the long end has turned negative. This is obviously where people are saying, okay, if it's inverted 28 times in the past 122 years and it's led to a recession 22 of those times, we have to take a step back and analyze where we're at. And we can see the last time it did it in 2019. And there's a lot of people that think that 2019, we were going to go into a recession. And then obviously we came into the pandemic, and that did its own magic in terms of putting the economy at a halt. The situation, my opinion is this is definitely a key piece of information that we should be taking a look at, something that we should be analyzing. But when I was doing my homework and doing my research, I actually found a better indicator, what economists actually look at, and we'll be taking a look at that right now. So this is actually the relationship between the 10-year and the 3-month bond. So this is actually where some economists actually say, forget the 10 and the 2-year, let's take a look at the 10 to 3-month. And we can see this relationship is way better than the 10 to 2-year. So are people overthinking the 10 to 2, or should we really be considering what the 10 to 3-month bond relationship looks like? And moving on, we're going to take a look at this website that I found from the New York Fed. And we can see here that it actually shows on the bottom a probability of US recession 12 months ahead of the term spread reading. So we're seeing that the probability of a recession is relatively low right now. We're actually looking at just over in the single digit percentage points of probability that there will be a recession. And you can look back at this chart and take a look at some of the other indicators that it's had, obviously as recent as 2008, 2009. And then we have the 2000 tech bubble, and then in the 80s when we kind of dealt with that stagflation, which we've covered before. So in all realistics, we really don't know what the future has in store. My opinion is that we stay invested, we pick quality names with pricing power, but it almost seems like the 10-year to 3-month, in my opinion, is probably a better indicator at this point. So let me know down below what you think. Do you think we're heading into a recession? Do you think it's absolutely chaotic right now, whether it's the commodities market or oil or anything of that such? Let me know your opinion. Let me know your thoughts, and we'll work through this together. So if you're still with me, I appreciate your support as always. Please hit that like button for me. And if you haven't already, hit that subscribe button. I hope you all had a great week in the markets. Happy trading.